I think that given we finally have gotten past that all-time high, you will see things take a pause. You guys just made a really good point that in order for this market rally to be sustainable, we do need to see a bit of rotation away from the big tech names that have done so well, and a bit more towards value and cyclicality. And so, I do think we're due for a pause. I do think that there is still upside. But I think a lot of this is being driven by stimulus, and it's going to be on the Fed and the federal government to keep those taps open here over the course of the next couple of months.
Right, but at your end, David, are you actively looking at those rotation strategies right now? Are you actively diversifying your portfolio?
We are. We think that the way that I would frame it is we want to own growth and we want to rent value. We like things like technology and healthcare over the long run. But we do recognize that as economic activity begins to come back online and as inflation expectations continue to rise, that is inherently supportive of value over growth. So rather than making a big directional bet one way or the other in portfolios, we're actually trying to remain fairly balanced. And to us, that means owning things like technology and financials as we position equity portfolios going forward.
And David, we talk so much about the role of the retail trader. The Robinhood traders pushing up names like Tesla and the like, the very popular tech names. But there's also a lot of money sitting on the sidelines and other investors who were more hesitant to get into that rally. And I keep wondering if they see this level, if they see the fresh record, if now some of that money will start getting in for those who fear missing out even further.
I think that there's definitely a fear of missing out aspect to all of this. And when we look at institutional money market fund levels, when we look at even retail investor cash balances, they for the most part remain elevated. It's really been the pure retail investor coming back into this market rather than advisors or institutional investors. And so, I do think that there's a lot of dry powder which will get put into the market here over the course of the next couple of months. The question that we ask ourselves is, will the story of the economy continuing to come back online occur in such a way that people feel comfortable deploying capital into equities? Again, we've pulled a lot of returns forward from the next couple of years. I think that we are due for a pause, but at the same time, I think you have people looking around and seeing the 10-year Treasury at 60 basis points and saying, I need to get into equities. I thought I was going to get a chance to get in before we got back to the all-time high. And that's not necessarily what has materialized. And so I do think some of this dry powder is going to make its way into the market, and that gives us confidence that there is room for another leg higher.